Bloomberg Audio Studios.
Podcasts, radio, news.
Hello, it's Merryn Somerset Webb here. We have got another great episode for you this week. Daniel Avigad, portfolio manager for the European long-only strategy at Lansdowne Partners, joins me to talk about his approach of making long-term investments in European equities. We don't talk about European equities enough on this podcast, so today we are making up for it. There's lots of great value out there. Stay with us and we will talk about it in a minute. But first, as always, senior reporter and author of the Money Distilled newsletter, John Stepek, is with me. John, hello.
Man.
Now, listen. This election stuff, it's really getting going now. And if you're not worried about your personal finances and your investments, now's the time to start getting worried, right? And if you're not worried about taxes going up, now is also the time to start getting worried, despite the fact, of course, taxes have gone up so much over the last decade, it's almost ridiculous. They're very probably going to go up more. Now, one of the things we keep hearing is promises from each party. This tax isn't going up. That tax isn't going to go up. I'm not going to put up income tax. I'm not putting up NI, blah, blah, blah. But we know that there are all sorts of stealth things they can do that a lot of people won't notice immediately. They'll only notice when it begins to really hurt. And John, I know you've been writing about this. Where do you think the risks lie?
Yeah, well, what I was looking at was the potential taxes on savings, so on pensions and ISAs. And the thing that really strikes me actually is not so much, where they're going to raise them, but the fact that the tax system's now become so complicated that if you pull on any given thread, you're going to end up upsetting a big enough group of people that it makes it incredibly difficult to actually do anything. So like pensions. So the first thing is obviously the lifetime allowance coming back. So Jeremy Hunt scrapped that earlier this year, or tried to scrap it, on the basis that it's kind of making NHS doctors retire early, basically. But actually unravelling that...
We should interrupt briefly to say that the reason they retire early based on the lifetime allowance on pensions is because they have very big pensions, just in case we need to come back to that later. Sorry, John, carry on.
Yeah, and absolutely. I mean, this is it. It's because the pensions are so large, and it's not just doctors. It's things like headmasters and senior police and things like that as well. So it's you're being forced into early retirement because you've got a huge pension.
For you.
And if it wasn't for the fact that public sector workers, exactly, people would be saying, "Oh well, let's get the violins out." But anyway, that's the reason that he did it. Unravelling that has proved a nightmare in the first place. And the idea that Labour are going to come in and reintroduce it is then not only creating all this confusion for, basically everyone, but it also means that whenever you reintroduce it, you're going to have to put in a whole load of new legislation to cover the fact that there was a period when people didn't have a lifetime allowance and they may have made decisions with that in mind. And then you've still got the outstanding problem of, well, what are you going to do about the public sector workers for whom this was originally implemented? So I think that, Steve Webb, the ex-pensions guy who was actually quite a good minister, said to Citywire the other day that I think the only solution realistically that they'll come in with is they'll just come back and reinstate the LTA, but they'll put it in at a much higher level. And that means that it won't catch the people that they don't want it to catch, but it also avoids most of the legislative hassle that they would have if they wanted to do things like carving out certain jobs or that sort of thing. So I thought that was interesting just because it shows that regardless of how zealously a new government wants to impose taxes on certain groups of people, it's actually starting to become extremely difficult.
Yeah. We know that pensions are somewhere that they're going to want to go, though, because that's where the money is, right? It seems incredibly unlikely that a new government isn't going to look at that vast amount of money sitting in private pensions and say, we really want to have some of that. So how are they going to get it?
Well, this is it. It's not going to be easy. The other big one...
How about the 25%? The fact that it's not actually 25% anymore. Yeah. It's 25% of the previous LTA. How about that? That seems to me like an absolutely obvious place to go to say, actually, do you know what? It used to be 25%. Now it's a set amount and it's just going to go down and down and down and down. You're actually going to end up paying tax on everything that you withdraw from your pension.
They can start doing that. But you know what? That has an impact on the defined benefit pension schemes as well. And that means the public sector workers are immediately taking a hit too. And that in turn means that you're irritating the unions at a time when the doctors are already on strike. I mean, I don't, I think you're right, and I think they will find stuff. In fact, I think probably getting rid of the pensions inheritance tax treatment is an obvious one, because that
is simple.
Yeah,
that is simple.
And that only applies to defined contribution people. So you're not going to get the public sector aspect in it. But the public sector thing is also the problem with, because, remember when George Osborne was still Chancellor, in fact, before Brexit it was, we were almost certain that he was going to get rid of tax relief on higher rate pensions, because obviously it's quite expensive and you could raise quite a lot of money from that, and it never actually ended up happening.
And that's interesting, because a lot of people couldn't understand why it didn't happen, because it seemed like an obvious thing to get rid of giving people paying higher rate tax, to stop giving them tax release at 40% or 45% as it would be today, and to say, do you know what, it's not fair that you get it at the higher rate and people paying lower rate tax only get 20%. Not right. So let's find a middle way. And I remember there was lots of conversation about how it was going to be 30%. Everyone would get effective tax release of 30%, which meant that people in lower tax bands would get a nice little bump up to their pension, and people in higher tax bands would suffer a little. So, that seemed like a reasonable way through, and it just didn't happen. Yeah.
And I mean, there's a logic to it. And actually, the logic to it has actually become probably even greater now, because if you think about it, if you flattened the tax relief to, say, 30%, now everyone in the private sector has got an auto-enrolled pension, and suddenly the auto-enrolled pension becomes a lot more attractive, and the young people who, we keep talking about how they're not interested in this stuff, they'll suddenly wake up to the fact, oh, wait a minute, I'm actually getting more in than I get paid now. Because you get an extra bump in tax relief that effectively gives you more money.
Yeah, constant top-ups, wonderful.
Yeah, exactly. So it would almost possibly be a good idea now, except that, again, the defined benefit pensions will get hit. And the fact is that now so many, is it 20 years ago or something like that, it's like almost no nurses were 40% taxpayers, and now 1 in 6 is. So you're talking about even the rank and file, rather than the rich NHS workers, will get pulled into a position where they are, because of the way their defined benefit pensions are not funded, but entitlement to them is done, because they have to make contributions from their salary too. So either you have to pay more out of your salary to get the same entitlement, or your entitlement's going to go down. So any government that tries to change the tax relief on pensions is again picking a big fight with the public sector unions. And I don't think that even a landslide Labour government would be keen to do that.
Well, it's also a Labour government that has an awful lot of senior people who have really only ever worked inside the public sector one way or another. Yeah. So it's hard to see them turning on the public sector in that crucial first 6 months when it would actually be possible. Hard to see them doing it. So the other place where there's an awful lot of money sitting around doing nothing that you might want to go after is in the property market. And we've talked about that a lot. And today, this week, the Tory party have said that they're not going to change stamp duty. They're not going to put CGT on primary homes. But a new Labour government might look at that, right? I don't think you can realistically put stamp duty up any further without destroying the property market in its entirety. But you could put a low level of index CGT on primary homes. You
could. And I think probably before that, if you got rid of stamp duty. The tricky thing is, obviously, the housing market is second only to the NHS in terms of its sacredness to the voters in this country.
And its sacredness to politicians who live in London, of course.
Oh, yeah, absolutely. And also, I suppose the other tricky thing is encouraging downsizing. If you want to encourage downsizing, but you introduce CGT on the gains that the downsizers have made, then, I think you get some interesting interactions there, much as I'm basically for it. So I think everything is difficult because we're now at the point where whatever you tax is going to hurt sufficient numbers of people that it's not going to be popular.
Okay, so we get back to where we often get to, which is that we're really, really glad that neither of us is going to be Prime Minister next time, because it's an awful lot harder than you think it is. Welcome to Merryn Talks Money, the podcast in which people who know the markets explain the markets. Here's my conversation with Daniel Avigad, portfolio manager of the European long-only strategy at Lansdowne Partners. Daniel, thank you so much for joining us today. Very nice to have you with us.
Thanks very much for allowing me to join you.
Now, we haven't talked about Europe much on this podcast. We've done a lot of UK, we've done a lot of US. What we haven't really done is sat down and talked about why you should be invested in Europe. Because interestingly, we're very focused here. We're very focused on the UK being ridiculously cheap, and we're very focused on the US being rather overshadowed by those few big tech stocks, by the Magnificent Seven, etc. But actually, Europe isn't doing too badly, is it? I mean, you look at an equal-weighted index, for example. Europe has been outperforming an equal-weighted index of the US, right? So, it's not so bad. So let's talk about why it's not so bad, and let's talk about why you're invested there, why it's your favourite market, and why it might get better. So, starters, why Europe?
I mean, the first thing I'll avoid is saying the obvious, which is something I don't feel very comfortable with, which is I don't think Europe from a macro perspective is especially exciting structurally. There's a cyclical rebound coming potentially, and that's possibly why we're seeing some of the improved performance of late. But
that's okay, by the way. We're very clear on this podcast that GDP growth is not the same thing as good stock market performance.
Perfect.
We can get that out of the way. We don't mind. But we would like to talk actually about some of the structural problems in Europe before we get into the market, maybe.
That's exactly right. I would first admit what the structural problem is and then think about how to invest in the solution providers. You know, the structural problem for me ultimately in Europe is the lack of natural resources. I mean, we just, in this region, don't have very many relative to the relative importance of the continent. So for the economy from which we're building, there isn't much by way of resources. There's not many people even.
Yeah, well, I was going to ask you about that, because when you come down to resources, one of the greatest resources for an economy is its people. Yeah. And of course, Europe is caught in a demographic crisis.
Exactly. So, you know, at total, if you really take the biggest number we can, would be 600 million. You know, maybe that's about the right number, but it's not growing. Let's take India or China. Each of those would be well over 1 billion. You know, if you think about land mass, actually, Europe's what? Very small in the context of some of the big economy. I mean, I think actually that's probably why so many wars have happened in Europe over the centuries, is because of this fundamental deficit problem in the resources that are needed by the population.
So maybe a smaller population is a great thing, and we should be thrilled that the fertility rate is collapsing across Europe.
I'd go
Take the population down to 300 and maybe they'll stop going to war.
Possibly, but if one shrinks the size of the market, normally that increases competition within the players within the market, which, unless it's structured well, can be anarchic. So I think a lower risk long-term solution would be to become more productive with what resources we already have.
Yeah, well, this is a problem across the board in the West, isn't it? This bizarre lack of productivity, and we have it in the UK, where our productivity has gone up, 0.4% or something for the last decade a year, when it should go up very significantly more than that. And I know UK productivity is particularly bad, but Europe can't exactly sit on its laurels either, can it?
And I think some of that is structural. Normally, productivity is linear, not exponential. So that means that every incremental invention stacks on top of the history of other embedded inventions in the economy. There's no multiplier effect. It's just additional. And, you know, the law of big numbers means that over time, the percentage growth rate in productivity in an economy will therefore naturally slow.
Yeah, but then occasionally you get massive productivity bursts when you have something new.
Completely.
And usually, historically, that's been a new form of intense energy, right? That's when we've had these big bursts of productivity. And we talked a lot about how we can have non-energy related bursts of productivity. You know, we thought the internet would do that, didn't we? And now we think digitalization might do it. But of course, we have this other problem here where we're beginning an energy transition to use a less intense form of energy, and that's not necessarily helpful for productivity.
Yeah, I think that's right. So the question is, I mean, looking at the academic evidence, at least from the papers that I've seen, looking over sort of 200 to 300 years of history, so it's quite a lot, and looking across as many countries as possible. I think the data spans about 58 countries, both advanced and emerging. I mean, what we've seen historically is almost always the productivity that is added to the economy is linear. It's not exponential. So very few breakthroughs are what you could call a general purpose technology, the GPT or ChatGPT.
Okay, so when we talk now, which pretty much everybody does, and we're guilty on this podcast of doing it as well, of saying it's going to be fine, digitalization and AI are going to drive a productivity revolution, which will save us from our demographic crisis, save us from our debt crisis, etc. You don't think that's going to happen?
I'd pose it a different way, if I may. How I would pose it is as follows. The supply growth potential in the economy is a function of the growth in the labour force and the growth in productivity. And the labour force growth cyclically is very high today. but I think ultimately, structurally, has some headwinds against it, not least the ones you remarked upon earlier, which was population growth is slowing, and the labour force is going to grow slower than population growth because of the ageing effect. In addition, normal productivity growth is slowing because of the law of big numbers. So just to keep the same supply potential expansion in the economy as we have today, we need AI to kick in. In fact, we need AI to sort of double the current level of productivity growth just to keep the economic growth of today into the future.
There is actually, historically, there is precedent for falling populations forcing productivity, right? I mean, there have been great gains in productivity after bad stuff like Black Death, for example. Huge gains in productivity after that, and huge rises in GDP per head, to the extent that we can tell, obviously, a long time ago. So there's some hope there in that a falling population can drive sudden, fast innovation.
Yeah, I completely agree. Typically, when labour inflation is very high, the break-even economics of technologies that otherwise were too expensive to invest in as substitutes isn't attractive. So, that break-even point is hard to judge. Yeah. But it could be that we get through that point and then we get a sort of natural productivity kicker for some years. Will it happen? Hard to know. I'm not actually bearish per se. I just think that the underlying economy is perhaps more fragile in its supply potential than is understood, which isn't to say that the benefit from AI couldn't be more than compensating for it.
Right. So let's talk about Europe. Europe now. What makes this market attractive to you, and which bits of this market are most attractive to you?
I think, again, structurally, the really interesting areas are those which are going to create productivity growth. Okay. And, where natural resources are most scarce, the return on marginal productivity is greatest. And I think Europe is the region where that is indeed been the case for many years. But if I think about the solution providers to sustainability and scarcity, I think that is best viewed from the prism of engineering faculties. So, over the last 20 or 30 years, the way as an investor to invest in growth has basically been in
America.
Well, software engineering, which is America, it's Silicon Valley. But the question is, aren't there other engineering faculties who are going to become increasingly valuable in the next 20 or 30 years? And I would say mechanical and materials engineering will become very important. I think electrical engineering is also going to become very important. And actually where the sort of global excellence hubs are more distributed for those types of technology. In fact, in Europe, we have two, in my view. The first one related to mechanical and materials engineering is in Scandinavia. It's a consequence, I think, of the old mining economy in the north of Sweden. I mean, if you thought about what is the analogue to OPEC in Europe, it's Norway. Yeah. If you thought what's the analogue to Australia for iron ore, it's Sweden. And I think the very abundant and cheap energy in northern Europe, combined with long-term family capital structures, has created a sort of network of real excellence in a vertically integrated way in mechanical and materials engineering, so capital goods. And I think perhaps with France, which is perhaps surprising, it was to me, I think that's where the sort of excellence for electrical engineering actually resides. And perhaps that's a consequence of, I don't know, my guess would be it's about defense. I mean, after centuries of wars with neighbors, it eventually becomes important to think about how to be self-sufficient in cheap energy. And I think the original focus on nuclear has created a whole industry vertical that leads a number of companies in France to be global champions in the electrification wave.
I mean, it's interesting, isn't it? Because there is going to be there's a deficiency of companies operating in this area, because for decades our global demand for electricity in Western countries anyway basically flat. Right? Nothing happened at all. Just electricity demand stayed flat, and people kept saying, "Well, it'll go because of this, it'll go because of that." Kind of never did. And now, of course, demand is rising incredibly fast across the West, and here in the UK, for example, it can take years to get connected to the grid if you have a project that requires connection. There's incredibly lengthy waits. So suddenly we all need equipment and ideas that we haven't needed for decades.
And I think the trick is to recognise the point you just made, which is there is a step up in the demand function for the electrification industry. Yeah. That is probably quite protracted. And then B, find within that electrical industry value chain the niches where the barriers to entry for new capacity to respond to that increased demand is quite restrained for whatever moat that exists. And there can be many different moats. But I think that...
Talk us through some of those niches and some of the companies that are operating there.
I mean, the sort of key learning is sort of 20 years ago in Germany, there was major subsidies to try to create a domestic solar industry. And actually, the subsidies were structured in such a way that in the end, what happened was that capacity flooded the market from China at a much lower cost than the domestic producers could compete against. And despite the inflated demand because of the subsidies, the supply over-responded and everyone went bankrupt.
Yeah, and Germany never developed its own industry.
Exactly.
Yeah.
And you could say that today we're suffering the consequences of that indirectly. But I think, if you've sort of thought about it from, well, where are the barriers to entry much higher? I mean, there are plenty actually, but they're niches. It's not so much sectors. And, targeting those, I think, is probably the most optimal way to do it. And those barriers are typically, to answer your question directly, normally it's related to IP. So sunk IP after many years. I mean, if you think about the model for the future, it isn't sort of so much. The question is, are we moving from a business where business models who have the IP that solve the sustainability crisis that the world is probably facing, whether the price they sell their products at will reflect their IP or just their cost of production. And I think in the last 10, 20 years, it's reflected the cost of production. And I think in the next 10 to 20 years, it's probably going to reflect the value to the customer through the IP that they alone or very few others can provide.
Okay, so that would be a huge change for a few companies.
Yeah, so it's moving from basing pricing off raw materials to basing pricing off the technology.
I'm going to ask you to give us an example.
Sure.
You're avoiding it.
Kind of. Let's take the tire. I mean, it can be so what I'm not saying is that the really interesting opportunity is investing in venture capital or very early stage deep tech in Europe. It might well be. That's not my point. It's not my expertise. What I'm actually saying is that there's some companies out there which have been investing for 200 years in an industry that looks like it's commoditized and boring, but actually is enjoying a structural shift in its demand function, that they alone, because of their IP investment, sunk investment in R&D over many decades that others haven't replicated, can disproportionately benefit from. Example would be the tire industry. So car tires. The idea is that historically you could sell your tire to reflect the cost of rubber, and the Chinese new entrants into the industry have been able to produce those rubber tires at a cheap enough level, given their cost advantage, to undermine the pricing ladder in the West. And they've been taking market share. Now, today, I think things are changing. In fact, some of the domestic European producers who have really invested heavily in trying to improve the energy efficiency of the tyres are starting to be able to price their tyres at different levels to the very low value added imports. And that's because, for example, the electric vehicles are much heavier because of the battery than the traditional combustion engine cars, and therefore need lots of different performance attributes from their tyre in order to meet the safety standards, the energy efficiency standards that the regulators are increasingly and restrictingly imposing on the industry.
Can we go back to, you mentioned earlier when we were talking about Scandinavia, you mentioned that one of the things that kept these companies going was long-term family capital structures. Is that something you look for, companies with a family element to them?
Yeah, look, I think it's a subset. I mean, in my view, really what we're looking for is companies whose management structures align with the incentives of long-term providers of capital. So in effect, what we're looking for is principal-like behavior from company managements as opposed to agency-like behavior. Mm-hmm. One subset of the universe of management teams that have that mindset are founder owners. And, that's because they've got skin in the game. And for them, it's a project that should exceed their lifetimes. Now, there are others. It's just a case of finding management teams that think like that. But I do agree that family ownership in general is a good place to look. The one thing I would say, however, I wouldn't say all family owned companies are the right place, because what we typically have found in the past with such management teams is that the constraints are often less, which means that the risks from the risks can become more non-linear more quickly. And that can be either positive in a virtuous circle or negative in a vicious circle. So it's very important to discern between the two and recognize that that risk is also there.
So let's move on then from electrification. What other areas are interesting to you?
The other issue is probably the aggregate indebtedness of developed economies, summing up both private and public debt relative to GDP.
I'm fascinated to find out how we invest in the solution to that.
Call me naive, but what I'm amazed by is if you compare total economy debt ratios versus just before the COVID crisis. So that's a clean period. Let's not think about the noise in between, but now and before the crisis. Total economy debt ratios haven't fallen in most countries, despite the huge inflation shock that was viewed as the most.
Brought it down in real terms.
Well, that's the most politically expedient way to reduce indebtedness, and it hasn't as of yet worked. Large amounts of debt create fragility in economies. I guess there's a smaller range in which the economy can evolve without it causing ruptures. I think it probably pulls a bit at the social fabric of a society, and then it's quite hard to see how that will evolve over time. Productivity growth, I think, shrinks in such environments.
It seems to affect growth.
I mean, it was really interesting. I looked at some polls, again, at some academic papers that I've seen, maybe there's others, but the level of trust between citizens has basically collapsed since 1960. The level of trust in governments has collapsed since 1960. So, if governments are spending more and more money, but people don't trust it, then I presume over time they will eventually start saving. And, that's probably because they think taxes are going to have to rise because the investment return on the spending isn't going to yield its cost of capital. And so I think that slows things down, and that's potentially the issue. So sort of the activist in the room isn't so much the providers of capital, it's actually governments and other stakeholders. And I think that's an important point, because that means that if you're investing in corporates over the long term, part of the job is to avoid the things that are going to face that problem, which is that, the state is going to need more money.
Okay, so you have to avoid the areas where the state is going to go.
Yeah, I think so.
So how do we find areas where the state is not going to go?
So that comes down to the solution providers. And, I think the solution providers I would define it as areas that are likely to retain their relevance in the future economy, where I would define relevance as able to grow as much as the economies to which they're exposed, but with one caveat: it has to be in hard currency, so it has to be in dollars or something like that. Okay. And economically not that sensitive.
We're going to need an example.
So the examples there would be, it's niches, not sectors. So the old days is sort of utilities, telcos, media, retail. Maybe it's pharmaceuticals. I think that's hard to invest in big size, because they're losing relevance relative to the economy because of disruption, because of regulation, because of technology, because of consumer habit shifting. The areas where you can invest are specific: pest control, industrial gases, low-cost airlines, data services infrastructure.
I'm missing something. Why would these particular sectors escape a load of government regulation and escape perhaps taxation that other sectors would suffer?
First of all, we need them. Second of all, they're not in the public eye.
Okay.
They're not directly regulated in the same way as, let's say, a telecom company or a utility. I mean, let's take telecoms for an example. There's a sort of 3 telecom networks in China, 3 in India, 3 in the US, and Europe's got, I don't know, hundreds. Yeah. So how come? And they're not able to earn a fair return, but we need them to invest, because every industry, to be competitive globally, needs high-speed digital infrastructure.
We need them to merge.
I would say we do, but the obstacles to them being able to scale up are that there's a lack of alignment in the incentives of stakeholders with shareholders. So although capital providers recognize that there is a need to merge, it's not allowed. And so what you have is this sort of underinvestment in a critical piece of European infrastructure, really because of the different time horizons of the different stakeholders. Actually, the horizons of many stakeholders is just too short term, and the behaviour is, in my opinion, too agency-like and not enough principle-like. And I think that's the constraint which leads to the large amounts of debt in the economy, because a large number of those decisions, a large number of small decisions like that add up to debt. And so avoiding those places, unless you think you're at the tipping point, is probably in time the right thing to do. And then entering those areas where these industries are growing in relevance relative to the economy and not in the line of fire of governments may be interesting.
Sounds to me you've got an awful lot to avoid if these are the criteria. Is your universe relatively small? Once you've taken out everything that you're under these parameters you can't really touch, how many companies are you down to?
I would say this, of course, but I can see why the environment might be more favourable to active investing over the next 2 decades, let's say.
You've gone exactly where I wanted you to go without me even having to direct it. It's amazing.
You teed me up. And and that isn't only because, the sort of hit rates on these sort of large tracks of defensive or historically defensive business models, hit rate in investing in those, it used to be 2 out of 3 you get it right. Now it's 1 out of 3. And when you get it wrong, it's far worse than when you get it right in terms of the alpha you can generate. So I think omission is going to be a core driver of alpha in the same way as commission. So we'll have dual sources. And I think, when you sort of drill down into what is therefore the addressable market, there's still a lot of companies in Europe that are really well positioned, still valued as if they're European, when in fact, they're really interesting businesses fit for the future.
I love the way you say valued as though they're European. That's a bad thing.
Well, yeah, I mean, so much lower multiples than you get in the US. So
I've got a list of things that you're interested in here. And one of the things we touched on, but we didn't talk about properly, was digitalization and how that might change the parameters for companies. When we talk about productivity and the need to cut costs and need to invest in R&D, etc. Digitalization is our big hope, but we haven't really talked about it properly.
Digitalization is probably an enabler of increased market concentration in many industries, because I think the large win when the investment budget requirements go up. And you can sort of start to see that happening in a number of industries in Europe, but it's still very far away from what we've seen in the US. I saw, for example, that I think it's the top 5 players in the average US industry are now representing 40-50% of the market. Yeah. In Europe, it's far more fragmented than that. So I think it's just going to accelerate market share shifts over time. The real question is, the Gen AI piece. And, it's very hard to know. We've had, as you said, 2 major non-linear or exponential functions in terms of productivity in the last 2 to 3 centuries. And I think the first was related to, the steam engine, and the second was related to, the computer. And is this the third? It's hard to know.
Yeah, it doesn't quite feel like it yet, does it?
I mean, I think it could. We certainly have the infrastructure in place at households and corporates, i.e. computers and technology, for it to be distributed very rapidly. We have mobile phones. So you could see how it could come about. But it's not something I would, at this point at least, bet on. But I wouldn't be surprised if in a decade or two it had major transformational impacts on lots of businesses that we can't conceive of at this point.
Can't conceive brings me on to ESG and your overlay there. Is there one? How do you approach this?
I mean, we try to build, I guess, our own macro econometric model of the carbon emissions of different industries. So we try to build a sort of carbon cost curve, for all of the tons of carbon emitted, which industries emit what portion and what would be the price of carbon required to economically incentivize them to switch to an alternative technology where carbon is not emitted. And that was really interesting because it sort of led, in our opinion, to sort of an implied required price for carbon that wasn't affordable in the current economy, and indeed was one where it felt like there would be large levels of misalignment of incentives between various stakeholders. So, the European Union versus sovereign states, the South versus the North, the old versus the young, pensioners versus students, and really a large level of misalignment of incentives across a large number of axes. And so, my view would be that ESG is inherently a sensible approach, certainly for a region starved of natural resources like we just described. So I understand why we're doing this.
But you're talking about the E.
Talking about the E mainly. We can come to the others in a minute. But the
Because the E is not always compatible with the S, as you just mentioned, with misalignment, etc., of incentives and outcomes. I was talking about this with people earlier, and we were talking about the cost of the transition. Where does it end? Who picks up the cost in the end? And in the end, the main fall in living standards or difficulty will happen at the poorest end of society in the UK, for example. It's colder up north, people are poorer up north, they're going to have the same energy bills, so we'll see fuel poverty becoming much more common up north as bills rise. And what does the government do about that? That kind of misalignment is interesting and rarely discussed.
Yeah, as well. I mean, talking in those dimensions, those who aren't born versus today's population, which is a key one as well. I mean, I think the concept is makes a lot of sense, but the implementation needs to be done very, very, very carefully. And I'm not convinced that the way in which we've tried to implement this through sort of top-down regulatory approaches has enough granularity to create favourable outcomes. I think there's a lot of unintended consequences that need to be considered. To be honest, I mean, I think there was 40,000 deaths above trend during the winter with the energy crisis in Europe. Mm-hmm. And, in reality, had we have thought through the energy transition policy, those could have been potentially much less. And I think it's really important to think through how we get to the endpoint rather than demand the endpoint immediately, because it sort of disincentivizes the investments in industries that are going to be required in that transition. And it's sort of a difference between what you want and what you can have. And that needs to really be thought through, in my view.
If you're an investor, if you have a strong feeling about E or S or G, how does it happen? What does the corporate activist, the investor activist look like?
Well, I think they're very different to the past, right? Investor activism, if it ever was sort of Gordon Gekko, which it obviously wasn't, that model, going back to our stakeholder stack and finding an equilibrium point that's sustainable, that was the problem, wasn't it? Because you had sort of capital trying to extract excess share of the economic value added or rent from every other stakeholder in the business. They were just basically firing everyone and trying to take all the profits up front. Let's just say that was the model and leverage. I don't think that's the future of activism. The future of activism is actually different. I think the future of activism will be trying to get each part of the stakeholder stack to behave as principals as opposed to agents, which is sort of thinking about government, the labour unions, the consumer as sort of partners in the long run success of the business and finding an equilibrium within them. So that's actually not just saying committing to what a company will do, but actually trying to influence the outcomes of policy in a more sustainable way. Although capitalism in the GFC clearly had some part of the blame. And that means that providers of capital are up against it when they're trying to influence outcomes for society, because the perception is that, greed. Actually, there's large amounts of the rest of the stakeholder stack that have also been guilty of thinking short term.
Yeah.
And, it's just this longer term mindset that's required everywhere. Exactly.
Yeah.
So the problem is much more than that.
Can we talk a little bit about your portfolio, about some of the top companies, some of your favorites in your top 10?
So that would be Michelin, which we've held for many years, well over a decade, and they, in my opinion, invented a lot of the real innovations in the tire industry over the last 150 years. And although it doesn't feel like it, there's been many. Starting with being able to replace tires. They were fixed at one point. And then we moved to the radial tire, then we moved to the run flat tire. Now we've moved to EV-based tires, energy efficient tires, okay, so on and so forth. And actually, ultimately, they were the principal innovator, I think, of many of those innovations. And the IP investment sunk by that company has been, 2 to 3 times everyone but the number 2 player. And if actually you added the 3rd and 4th and 5th players R&D, you still wouldn't get to Michelin's budget.
So on the verge of being able to push their prices up fairly dramatically, you think, over the next decade?
I think it will reflect technology and the value of that, yes.
Okay, I'm waiting for another.
Sure.
Hopefully.
So there is another, which is Rentokil, the pest control company.
I was going to follow that up. Yeah, okay.
So that, I think, is a very interesting industry because pestilence is on the rise.
I didn't know that.
It is because of the growth in population, the urbanization of the population. And in the principal market, which represents half of the global pest control market, the US, people are moving to the south where it's warmer.
Yeah.
And there's more pests as a consequence of that, as well as the fact that the propensity to outsource to a third party to solve your pest problem is
rising. But is there much
It's
of a
rising.
moat there? Can't anyone kill pests?
It's actually a network-based business, so scale really matters. The economic key to the industry, I feel, is reducing windshield time for your pest control technician. So if you have 10 customers in one street, it's much better than having 10 customers in a city. You'll see many more customers in a day if they're nearer to each other. So you get the operational leverage from that. And that means that you earn more. And that means you can price at a discount and still earn a fair return, or you can take market, or you can earn excess returns and then invest it in marketing. And the trick is actually to be, when someone Googles pest control near me, near the top of the list, and that takes money. So the bigger you are, the more likelihood of being in that position.
Okay, interesting. Well, I hope I don't have to use that one. Is there an interesting company in France involved in electrification, which we've always perhaps thought of as rather staid, but is actually rather exciting?
Schneider,
Yeah.
I'm sure you would have also in your mind.
That is what I had in mind.
Yeah. So, the grid transformation is just very, very drastic, because when we connect renewables, they don't fit into the way the grid was designed over the last century. And so the grid not only has to be adapted for additional capacity, it has to come from decentralized sources that have different sort of production cycles to the capacity that you used to have to connect, which was just a gas turbine somewhere. So there's a sort of major deficit, I think, in the electrical equipment that is required to enable this. And on top of that, you have this sort of AI-led demand for data center capacity, which is sort of got a lot of electrical equipment in there from companies like Schneider. Yeah. And so, you have this sort of two waves of structural demand acceleration, one from the energy transition and the other from the AI growth dynamic.
Okay, a lot of electricity, a lot of cables. If you were to only be allowed to invest in one asset class over a 10-year period, and I only gave you a choice of two asset classes, one of which you may argue about whether it was an asset or not, and those two asset classes were gold or Bitcoin, which one would you choose?
Gold.
Not a trick question. You would choose gold. Why?
In the 30s, they were trading rocks. So, anything that is an alternative to money, I think in this example would do well. But it's finite supply, and
people would say that a bit about Bitcoin. Finite
true,
supply.
But there's not a finite supply to the number of digital currencies that can get created.
Yes,
and that I think is probably the one thing that differentiates gold.
Okay, I agree with you entirely. But, not all our audience does. I know. Luckily, we have a young person in the office today. Sam, Bitcoin or gold?
Bitcoin.
I'm showing my age.
Tell us why, Sam. Come over to the microphone. Tell us why.
I think cryptocurrency, whether you like it or not, it might still be a big part of investment in the future. Bitcoin will still be like kind of the first thing to blow up in that cryptocurrency space. So I think it's important that people are still always going to be investing in that. And it's still worth a lot today.
Sam, thank you. And Dan, thank you. John, the end bit there, I put that kid on the spot a little bit. 16-year-old come into the office to do work experience and suddenly he's forced to choose between Bitcoin and gold. I think he did a good job.
I think he did an excellent job. He gave a contrarian answer, and now he's famous.
Now he's famous.
What more could you want?
Yeah, although warning kids, don't come do work experience with us unless you want to end up on a podcast.
They'll be queuing out the door.
They will be. And all saying Bitcoin, I'm guessing, the 16-year-olds, but we'll find out. What did you think about Daniel? I really enjoyed my conversation with him.
I thought it was great. And also, reading the transcript, I would say it's one of the most dense episodes that we've had for a long time.
What does that mean, John?
Well, information dense. It's one of those ones I feel I could probably listen to or read through twice.
Everyone should feel welcome to listen to our podcast as many times as they like. over and over, please.
But I thought it was really good. I think one of the things it illustrated is the actual benefit of a good stock picker.
Yeah.
Because what he's looking at is, it's quite easy at the end of the day to talk about big trends and waft your hands and all the rest of it.
Yeah.
But he actually boiled down that stuff and this is how it actually affects stocks. Mm-hmm. So, like Michelin's a really good example. I would never have thought, right, R&D in tyres. Well, tyres just go on your car, don't they? Aren't they basically commodity products unless, you're a boy racer who cares about his alloy wheels or whatever. But clearly I'm completely wrong. And Michelin's actually a sort of, almost pseudo-tech company because it is pumping this R&D money in and it is getting kind of intellectual property. And it is taking advantage of the electric vehicle kind of revolution, etc., etc. So I think it's that kind of thing, kind of connecting those dots, and also looking at things like R&D budgets. I remember our old colleague used to do that a lot at Money Week. But it's this key thing about translating trends into moats, which I thought was really interesting.
Well, it's the way he said, every time I asked him any specific questions, and we talked about these big trends, and I said, well, how do you invest in that? How do you invest in that? His answer was always, well, it's pretty niche. It's pretty niche. He didn't say, oh, well, you buy this sector or that sector. There's nothing about sectors, just it's very niche. You've got to be precise. And these are the few places to go. I was also, what I found very interesting was the conversation about big government and debt and deficits, and we can talk about that in a big way, and about how it makes economies as a whole fragile and it makes companies fragile. And then how do you invest in that? Well, you need to find companies that are as far away from government as possible, and companies that are out of the spotlight, that that you can't. People don't particularly see. And of course, tyres are yet another example of that. Who sees tyres, as you just said?
Yeah, I mean, I think, again, that point about omission as well. In fact, actually, thing about it, more than anyone else, he's probably made the case against passive and for active better without kind of really trying to than anyone else we've had on the podcast so far. In practical terms.
Yeah, in practical terms, he's done it very well. Yeah. Right.
Yeah, and actually, even Rent-A-Kill, I was sort of sitting there going, why Rent-A-Kill? And then it's like, well, actually, if the climate's getting warmer, then we're all going to have more bugs annoying us. So actually, there's a lot of logic to that.
I was interested as well, by the way, in what he said about family companies, because I've written in the past about the extent to which family companies, or companies where family have a large stake, so you get a symbiotic relationship between management and shareholder, because they're the same thing for once, about have their tendency long-term to outperform. So it was interesting. That's something that he picked up on as well.
Well, yeah, and again, I liked that Dan also pointed out that you can't just kind of blanket, say, family companies, because some of them do have issues, and it's leveraged on either side. It's like they can completely ignore minority shareholders, and it's quite possible that the founder's an egomaniac, control freak. And so, I thought it was interesting that he still highlighted that. He's obviously a very kind of nuanced thinker.
Thanks for listening to this week's Merryn Talks Money. We'll be back next week. In the meantime, if you like our show, rate, review, and subscribe wherever you listen to podcasts. And keep sending questions or comments to merrynmoney@bloomberg.net. I think we've made very clear that we do sometimes drift away from our core purpose here, so please do set us straight. This episode was hosted by me, Merryn Somerset Webb. It was produced by Sami Sadi, additional editing by Moses Andam, and special thanks, of course, to Daniel Avigad.